So now these liquidity ratios, these are, look at this is a very simple one. You can easily remember this one. When you hear liquidity, it has to do with cash flow, right? So it has to do with short-term cash flow. So the ease of converting assets to cash assets, it majorly has to do with short-term cash flow, working capital. So know that working capital basically is current assets minus current liabilities. This is not really a ratio, this is just a statement of fact. So in liquidity ratio, we're going to deal normally with the current aspects of the financial statement, that is the current assets and then the current liabilities. So the first formula we're looking at is the current ratio. So we know that the current assets are the resources available to pay up current liabilities, right? In this ratio, the current asset is the numerator, and then this ratio therefore tells us to what extent current assets provides cover for current liabilities. You can see that the formula is should be current assets over current liabilities. To what extent can current assets cover current liabilities? Because we know that in a short term, current assets are what is used to pay off current liabilities. So to what extent is current assets able to cover these current liabilities? So now whatever we calculate, this formula is to ratio to 1. So if you calculate and the answer is 2, we know that the answer is 2 is to 1. If you calculate and the answer is 1.2, we know the answer is 1.2 is to 1. How do we interpret this ratio to know if the company is doing well or not? Like we said, ratio is usually done relatively, so we are comparing this. If we're asked to calculate for two companies and know their liquidity, and then we calculate for the first company, and the first company has a current ratio of 1.5, and then the second company has a current ratio of 0.8, you can see that company A is doing better than company B in terms of liquidity because they have a higher current ratio. Their current asset has a higher cover for their current liabilities, basically. Right, so now we can see that their current asset is able to cover up their current liabilities, not just once but 1.5. So it will cover it at first and then it will remain an extra 0.5 at the top. That's why it is to 1. So this to 1 is representing our current liabilities, and then this 1.5 is representing the extent that which our current asset can cover our current liabilities. So the next formula we're going to look at is the quick ratio. So this is just like the current ratio but with a little twist. So another name for this formula, this is also called quick or acid test ratio, or you can also call it liquid ratio. This ratio calculates the extent by which the most liquid current assets can cover current liabilities. In calculating this ratio, we minus inventory from our current assets. So this formula is written as current assets minus inventory divided by current liabilities. So I'm writing this ratio like this means that we're removing the least liquid assets. You know, when we talk about current assets, if you can remember how it looks like in our financial statements, when we talk about current assets, you know, you always see the inventory first, then you will see our trade receivables, then you will see prepaid expenses, and then you will see cash. So removing our least liquid assets, because you know that it is not easy to convert inventory to cash to the fastest. Like if you want to pay up your debts today, if you have an inventory of 100,000, there's no probability that you might actually be able to sell that 100,000 inventory today, and cash is enough to pay up that debt if you want to pay it today. And you can also make legal action against your debtors to pay up your receivables immediately. So these are the most liquid assets that can be used to pay timely debts, right? So that's why this is called an acid test ratio. It doesn't negate or invalidate the current ratio. It just also is calculated along with the current ratio to show the quickness test, to show a test on how possible it is, like how realistic it is, because current ratio might not be as realistic as it may seem, because you might not be able to convert inventory the fastest to cash, but quick test shows realisticness in its calculations. So that's why this is calculated. Um, so you know that this is also calculated is to 1, and the benchmark for this, there's no appropriate benchmark. Like I said, ratio is done relatively, so you compare. So I also want to say something. When we have current ratio, remember we say we are finding the relative, right? So now, the apart from that relative sense, the benchmark for current ratio is 2.2 is to 1, right? So 2 is to 1. So if you're measuring for two companies, and then for example the first company, their current ratio is up to 3 is to 1, and then the other company, when you calculate the current ratio, is something like 0.9 is to 1. When you look at this, obviously you would say company A is doing better than company B because of they have a higher current ratio to company B. Yes, but depending on how you explain it, you can also explain it in the sense that company A has idle funds and they are carrying out what we call under trading. They are not using enough of their assets in making business, which shows that they are not being efficient enough. Does that make sense? But this company now, we can also say that they don't have enough current assets to pay off their debts, yes, but and we can also say that they are over trading. So despite A is better than B, if you're asked to advise them on a separate note, you have to advise A to start trading more because it seems that they are under trading their assets, and B to work on their liquidity because it means that they are over trading their assets. Does that make sense? So the benchmark for current ratio is 2.2 is to 1. The benchmark for current ratio is 2 is to 1. And then the benchmark for quick acid test ratio can be seen as 1 is to 1. So I don't think there's an appropriate actual benchmark, but 1 is to 1 is the most acceptable because after minusing inventory, 1 is to 1 still shows that they are still efficient. So if they minus inventory and then their acid test ratio is still within this 1 is to 1, then it shows that they are efficient and they are working well. But if they have less than this, let's say company A has 0.8, for example, is to 1, and then company B has 1.5 is to 1. You can also say that company B is under trading because they have excess of capital, excess of assets, because of the benchmark is 1 is to 1, and then they have excess of assets. And then you can say that company A is at risk of liquidity because even at acid test their liquidity is quite small. Next thing we're going to look at, so we're going to look at debt ratios in the next part. So now we're going to look at debt, so now we're going to look at the next categories of ratios, debt ratios. Debt or solvency ratio. So debt or solvency ratio is mostly focused on long-term obligations. So users of financial statements, particularly let's say for example loan users of financial statements, for example loan suppliers, are mainly interested in the long-term survival of a firm. So this long-term survival of a firm has to do with their long-term obligations, the ability of a firm to be able to cater for their long-term obligations. Specifically, they are interested in the firm ability to pay long-term obligations, basically. So solvency analysis assesses the relationship between debt and equity. So when you assess the relationship between debt and equity and analyze the extent of leverage or gearing, is able to tell the extent tell their long-term obligation and if this company will be able to pay their long-term obligations. So these ratios are also called debt ratios or solvency ratios or gearing ratios. So we're going to look at 4 ratios under this particular category. The first one we're going to look at is debt to equity ratio. So these ones are just quite straightforward because of it is in the name, debt to equity, right? So it is straightforward that okay, it's obviously debt to total debt divided by total equity. So total debt first of all is equal to long-term plus short-term debt, right? So when we talk about total debt, we don't talk about this debt. No, let's write it fully. This is equals to total debt divided by total equity. So when we talk about total debt, it is equals to long-term plus short-term debts, right? So and then total equity has to do with the total ordinary shares that are used to finance the company, the total owners fund basically. So let's see. So long-term debts, so so total debts. So this ratio is also relative, right? So even after getting your ratio, you have to compare it to either the industry ratio, another company's ratio, or past or previous years ratio, to know if the company is actually doing well or not. So if this ratio is higher, is actually bad. So if the total debt ratio is high, if the total debt to equity ratio is higher, this signifies bad. So let's just write this here, greater. So in the case of this ratio, if they are higher, it is actually bad. So let's just write this here, greater equals to bad, right? So because of its debt over ratio, we don't want our debt, because of its debt over equity, we don't want our debt to be more than equity. So if our debt, for example, here was 5,000 and our equity was 1,000, or sorry, our equity was 2,000, this would have been 2.5, and this would have been bad because our debt is more than the owner's fund. Because debt is repayable in full at a particular or stipulated date or time, while equity is owner's fund, basically the founders' money that they put into the business to generate returns. So those ones are repayable dividend after dividend, and not just in full at a fixed date. No. So it is bad if you have your debt higher than your equity. So for example, if you're comparing two companies and one's let's say for example company A and B, and company A's debt to equity ratio is 2 and company B's own is 0.5, company B is obviously better in this case because of they have a lower debt to equity ratio, and a lower one is good, the higher one is bad. So now let's erase all that. So the next formula we have is the long-term debt to equity ratio, and the formula for this is also very direct: long-term debt divided by equity. So long-term debt divided by equity. So when we say long-term debt, basically what does this include? So let's write this out. Long-term debt. So when we say long-term debt, this includes non-current liabilities. To write non-current, NCL as non-current liabilities, let's not forget, plus our preference shares. So we know that preference shares is not part of equity, right? So when we mean long-term debt, we mean non-current liabilities plus our preference shares. When we say non-current liability, we mean all these loan stock, bonds, and the rest, and then preference shares. Also, in this case, greater is bad. Greater is equals to bad. Okay, so now the next ratio we're going to be looking at is the fixed interest cover. To number 3. So the formula for this is PBIT. So when I say PBIT, I mean profit before interest or tax, or sometimes you might see EBIT, which is earnings before interest or tax. So let's write this full, since this is profit before interest or tax divided by the interest expense. So PBIT divided by interest expense. This is the formula for interest cover. So this formula basically is to know to what extent the profit, the PBIT can cover the interest expense. So we know basically that interest is paid from the profit before interest or tax. In the financial statement, after getting your profit before interest or tax, usually the next thing you minus is your interest expense, right? So now when you're calculating this ratio, you basically want to know how much your profit can cover your interest expense. How much your profit can cover your interest expense. So in this, greater is good, right? So greater, so it was just in the solvency ratio that greater was bad. So in this, greater is good. So the higher the better. So if you're comparing two companies now, if you're comparing two companies and one has a higher fixed interest cover, that company is doing better than the other. You can also remember we do ratio relatively, right? So you either compare two companies or you compare from previous years. You compare within a company, so you compare from previous years using a standard, or you compare using the industry ratio. So now the next, okay, for example, let me just use an example to explain more on this. So for example in your financial statement, your PBIT is giving us 1,000 and then your interest is given as 100. So the fixed interest cover is going to be 1,000 divided by 100, and this is going to be 10. So this is going to be very good because it's very high. But for example, if the industry ratio is like 20, you can say that this is poor because it is lower than the industry ratio. If you compare it to another company and another company's own is 4, then this is extremely good because it is 6 times, it is higher than the other companies owned by about 6. So let's take note. So now the next ratio and the last for this segment, for this category we're going to look at, is the fixed dividend cover. So when we talk about fixed dividend, we're only talking about one thing: preference shares. This has to do with preference shares only. We normally hear dividend when we talk about shares, but for a dividend to be fixed, then we're talking about preference shares, because ordinary shares dividends are not fixed. So when you hear fixed dividend cover, it's only talking about one thing, and that's preference shares. So the formula for this is going to be profit after tax. So this is PAT, profit after tax, divided by the fixed preference dividend. Now the reason we're using profit after tax, that in the way the financial statement goes, after your PBI usually minus your tax. After your PBI usually minus your interest, and then after your interest you minus your tax before you even start paying dividend. When I'm saying dividend, in this case I'm talking about both dividends, both the preference dividend and the ordinary share dividend. So you pay dividend at the point of profit after tax, but you first of all have to pay your preference dividend before you can pay your ordinary dividend. So when you get to the point of profit after tax, after PBIT, you pay your interest, you pay your tax, you get to profit after tax, you have to pay your preference dividend before you even get to your ordinary dividend, right? So because of we use your profit after tax to pay preference dividend, that's why we are using profit after tax in this case. So again, this formula basically means how much does the profit after tax cover our fixed dividend. To what extent does it cover our fixed dividend? So to what extent does it cover our fixed, right? So basically this is, for example, if you have your profit after tax as 1,500 and you have your fixed dividend as 150, this is going to be 15 divided by 150, and your answer is going to be 10. So now this is the amount of times your profit after tax can cover your fixed preference dividend. Remember, you have to compare this and find the relative interpretation. Next, we're going to move to the last category, investor ratios or shareholders investment ratios. Investor ratios. So this ratio, this category ratio basically measures the return to shareholders. So now this ratio is mostly used by investors and shareholders, right? These are people that want to invest in the company, or people that may have already invested in the company, to understand the financial statements as it relates to them. So their main aim is to basically understand how the company is generating returns for them, and how the company is maximizing their holdings. Basically, that's their main aim. That's basically what they are looking out for. So now the first formula we're going to talk about is EPS. So this is called earnings per share. First formula we're going to look at is EPS, and this is earnings per share. Formula for EPS is profit after tax minus your preference dividend divided by your number of ordinary shares. So let me just write that down. Profit after tax. Remember, the PAT means profit after tax minus your preference dividend divided by the number of ordinary shares. So basically, remember that we said after getting your profit after tax, you have to minus your preference dividend before you can pay up your ordinary dividend. And you know that ordinary dividends are the ones that relate to shareholders. They're the ones that relate to investors. So now that's why we have to get that profit after your tax and your preference dividend, and then when you get that's what you call your earnings, and then that earnings divided by the number of ordinary shares. So now, how you get this number of ordinary shares in the statement of financial position, you might see something like 1 naira ordinary shares. You might see something, for example, usually 1 naira ordinary shares worth 100,000. So now, 1 naira that is usually attached to that ordinary shares in the statement of financial position is usually the nominal value of the shares, right? So now, or let's say $1. Let's use $1 instead for our international student. So you might see $1 ordinary share is equals to $100,000, right? So this $1 that might be that's always attached to the financial statements as the $1 ordinary share, that's the nominal value. So when you have the nominal value and you have the total worth of the shares, you simply do the total worth of the shares divided by the nominal value to get the number of shares. So 100,000 divided by 1 is basically going to give us 100,000. So it means that there are 100,000 ordinary shares in number, basically. So when you get your profit after tax, you have to minus your preference dividend if given, and then you get your earnings. So your earnings divided by that number of ordinary shares is your EPS, your earnings per share. So the next one we're going to look at is DPS, dividend per share. Dividend per share. So the formula for dividend per share is the total proposed dividend divided by the number of shares. So let's write that down. Is equals to the total proposed dividend, or total dividend proposed, divided by the number of ordinary shares. Now, when we say when we say the total proposed dividend, this is usually given directly. So even after the company makes a particular earning for a year, usually the earnings are not what is distributed. We have what is called retained earnings. So the earnings are what these shareholders make for that financial period, but the company might decide not to issue all those earnings. So the amount that is actually issued in return to the shareholders are called dividend. So now you know that earnings is equals to the dividend plus the retained earnings. So not all earnings are issued as return, some of them are retained. So now when we talk about proposed dividend, that's the amount that we're talking about, the amount that was actually agreed to be issued to the public, right? So that's usually a fixed amount. The company, so for example, if they calculate that okay, for a particular year they made 50 million earnings, after so much financial deliberation they can decide to only propose 30 million naira, 30 million. They can decide to only propose 30 million for dividend. So we can tell that the 20 million now is the retained earnings, right? So now this 30 million proposed as dividend, this is the total proposed dividend, and then the number of shares. So like I said, when you get the number of shares from your financial statement, you do your 30 million divided by your number of shares. So using the number of shares that we used when we're calculating EPS, which was 100,000. So if we're doing 30 million divided by 100,000, you're going to cancel all this out. So you're going to have 300. So each shareholder is going to receive a dividend of $300 per share. So each shareholder is going to receive a dividend of $300 per share. So the next formula we're going to be looking at your earnings yield. So equals to your EPS divided by your MPS. So your EPS divided by your MPS is, so this is equal to your EPS divided by your MPS times 100%. So when I say earning yield is a measure of the return on investment in shares. It measures the percentage of investment in shares that is returned. It measures the percentage of investment in shares that is returned. So it's the measure of return investment of shares. So when we say return, measure of return investment of shares, when we say earning yield, is, remember that EPS, this is the return, right? Remember that this is the earning of a shareholder from the profits in a particular year. And then MPS, this is the market price that the shareholder bought this particular share. So this is the investment in the shares and this is the return. So let's just label it. MPS is seen as the investment because this is the price they paid for the shares, for a particular share, and this EPS is seen as the return. We can see this as return or risk, return over risk. So EPS being our return and MPS being our risk. So the interpretation of yield earnings is basically means for the price of this MPS, it will yield this percentage. There will be this percentage yield on shares. So for example, your MPS was 10, and then for example your MPS was 1000 per share, and then your EPS was 300. So calculating this is going to be 300 divided by 1000 times 100%, and this is going to be 30%. So this basically means that for the price of 1000, there was a 30% yield on the shares. So for the price of 1000, there was a 30% yield on shares. So remember, you have to compare this with either the past year's ratio, the industry ratio, or another company's ratio in order to make a conclusion on whether the company is doing well or not, or whether the investor should invest or not. So the next ratio we're going to look at is your PE ratio. So this basically is seen as the inverse of the earnings yield ratio. So let's write this. This is called the PE ratio, and as the name implies, it's also called price earning ratio. The P means price and the E means earnings. So price earning ratio. So this basically is your MPS price as per the money paid for the shares divided by your EPS, your earnings. So your market price divided by your earnings. So this basically measures how long it takes the investor to recover the price. That is the initial investment in the company. The shorter the better. So let's write this one. How long it takes to recover the price. So how long it takes to recover the price. The shorter the better. So if it takes a shorter amount of time to recover the price, then it is good. So now using our formula that we using the figures or the digits that we used in the previous ratio, 1,300, let's calculate our PE ratio. So that is going to be 1,000 divided by 300, and this gives us 3.33. So it's going to take us 3.33 to 3.33 times to return. It's going to take 3.33 times for your earnings to pay up your price. Okay, so now we're going to move on to the next ratio. So let's just write here, the lower the better. So for example, if you're comparing it to another company and the company's one is 1.33, that is better. So you rather invest in the other company because you know that you're going to retrieve or return your price money faster than you would in this company. And if the industry figure is 5, you know that this company is doing better, so you have to invest in this company. If the industry figure is 2, you know that the company is not doing good enough and you have to invest in another company that might be doing better. Okay? So the next ratio we're going to be looking at is your dividend yield ratio. Let's write that out. Dividend, this is ratio number 5 under your investor ratio, yield ratio. Remember we looked at the earnings yield ratio just before. Now our earnings yield ratio was EPS divided by MPS, right? So in this case it is also going to be DPS divided by MPS. So this is the percentage of market price that actually comes back to the investor as dividend. The percentage of market price that actually comes back to the investor as dividend. So this is done in times 100%. So this is basically done the same way you do the other ones, and then you compare. Next one we're going to look at is our dividend cover. So we looked at, next one we're going to look at is our dividend cover. And dividend cover, this is the number of times earnings can pay out your dividend. So how many times the earnings can pay out your dividend. Remember that the earnings and what the investor earns in a particular year, it's not all that is paid out as dividend. Some of them are retained, right? So now dividend cover is basically trying to find out how many times these earnings can cover up or pay out as dividend. So the formula for this is your EPS divided by your DPS. That's your earnings per share divided by your dividend per share. And then this answer of this is usually given in times, so x times. Now I don't think right now you should worry so much about cramming the formulas, because once you understand each of these formulas, it's to make it easier for it to come to you. So once you say dividend cover, you know, okay, how many times dividend can cover, right? So you'll be able to guess that, okay, that's equals to EPS over MPS. So you don't need to start cramming everything. Once you understand it, you can remember the formula. When you understand it, you can also interpret the formula or the ratio. So the next ratio we're going to look at, and the final one for this video, watch out, and the final one for this video before we move on to the next phase of our topic is dividend payout ratio. So dividend payout ratio, so this is the final ratio for this video. Dividend payout ratio, this is basically how much of the earnings is actually paid out as dividend. This is a ratio to find out how much of earnings is actually paid out as dividend, and the formula for this is just the inverse of the dividend cover. The formula for this is your DPS, that's your dividend per share, divided by your earnings per share, EPS, multiplied by 100%. So how much of the earnings actually pay out as dividend, that's what this formula is trying to figure out. Remember that the shareholder earns a particular amount, and then from this particular amount some are paid out as dividend, the remaining is retained. So this formula is basically trying to find out how much is actually paid out dividend. So for example, our EPS is given as 1,000 and our DPS is 400. When you calculate this is going to give us 40%. So this is basically trying to tell us that 40% of our earnings are paid out as dividend. 40% of our earnings are what is actually paid out as dividend. And to check out our previous video based on our suggestions, click on the right button. Please ensure you subscribe for more, like this video, and leave something for us in the comment section. We're waiting for you to reply. Thanks for watching.